Paul Katie, thanks very much indeed for joining us.
Give the government some confidence. Think about the economy more broadly going well for China. The more interesting story is you look at TSMC.
Hi, I'm Paul Katie from East Asia Econ. Thanks very much for watching. We're a specialist research service looking at the markets and macro of China, Japan, Taiwan and Korea. We've done a few videos over the course of the last few months looking at a range of different topics, so you can check those out. What I wanted to do today is talk about China and China's export sector in particular. And obviously that's been in the news a lot. You would have seen, it's very difficult now, I think, to escape the idea of what's happening with China's exports. Either if you read the US press and you look at what's happening with tariffs, and obviously that's a huge issue, not just for the US consumer, but for China's producers. But also if you're in many other countries, you'd have seen a lot of the new exports that China is now producing, in particular the EVs that drive around around the roads, even though, like here in Taiwan, there's very few of those visible at the moment. But there's obviously something very big changing and something very big going on. So what I want to talk about is what's unusual about this, right? What stands out about China's export sector and what's happening with the external sector of China's economy, to try to tie that in to thinking about the implications of that for where China's cycle overall stands. And in particular, the thing I'm interested in is the implications of both on the exchange rate and in the context of what's happening with domestic inflation in China. So that's the second thing I'll talk about. And the third thing is then trying to think of some of basically to draw out this dilemma, which I think China increasingly faces at the moment, which is the one hand, the export sector and the trade sector really argues for exchange rate appreciation in China. Something which in terms of household consumption, household purchasing power, income per capita, all of these things should be very positive for China over the long term. On the other hand, the short-term cycle, which is actually where China needs a looser exchange rate because China is running into deflation. And I think that dilemma around the currency is perhaps the key issue that China is going to be facing over the course of the next 6 months or so, and therefore the key issue that market participants and people looking at China should be thinking about. So to set the stage for that, right, what's been happening with the export sector and the trade sector. And the big thing about this is this big increase in the trade surplus that's happened over the course of the last 5 years or so in particular. So if you go back before 2020, China was running a monthly trade surplus of about $40 billion a month. That trade surplus right now is over $100 billion a month. So there's been this massive increase in the trade surplus over the course of the last few years. Now, the impressive thing about that, apart from the number itself, is that's happened even though the US has imposed tariffs, right? And I'm not talking about the tariffs that's happened in the current Trump administration, and those tariffs are very high and they are very important for China. But it's more that tariffs were imposed in the first Trump administration. And even with that, China's trade surplus continued to increase in the years afterwards. So that's the kind of the standout thing, I think, to be noticing about what's happening with the trade side in China. Now, that increase in the trade surplus has sort of particular characteristics about it. And there's two things in particular that stand out. So the first of all is in terms of geography. Now, if you go and look at China's bilateral trade surplus with all of the other countries in the world, actually there's not very much change in that in terms of the absolute number. So China historically was running a trade surplus with most countries in the world. Today, China is running a trade surplus with most countries in the world. So from a kind of an overall point of view, there's not been very much change. What we have seen playing out with China's trade surplus is that there has been a big change with individual economies. And so if you look at the standouts really are Germany, Korea and Japan in sort of the developed markets, where the trade surplus with China has been running, it is now running a much bigger trade surplus than it was historically. And if you look at the rest of the world, there stands out some of the ASEAN countries, and Vietnam has been in the news a lot. But you can also talk about Mexico and about Russia, where the trade surplus has also increased a lot. So in terms of when you think about the trade surplus geographically, the big change that's happened over the course of the last few years is not really broadening, it's much more deepening. With particular economies, there's been a big change in the trade surplus. Now, if you think about that, particularly those economies in the developed world have been affected by the rise of China's exports over the course of the last 5 to 10 years. What stands out about that? What's the common characteristic of Germany, Korea and Japan? Well, they're all capital goods producers, right? They're big exporters in and of themselves, but the exports that they produce tend to be capital goods and they tend to be machinery. So this leads to the second peculiarity or the second characteristic of the current rise in China's exports and the trade surplus, which is it really is led by particular types of products. And so when you look at, again, if you think about China's trade surplus with other countries in the world, it's running a trade surplus with almost everywhere, just as it was 10 years ago. If you look at China's trade surplus by product, there's a very clear change. But back in sort of 10 years ago, I forget the dates I used, but a few years ago, China was running a trade surplus in about 40% of the different categories of manufactured products. Now it's running a trade surplus in 60% of those manufactured products. So there's been a broadening in terms of China's coverage and its ability to export into other types of products. Now, within the manufacturing sector, there's also another change going on, which is the biggest change has been in terms of these trade surplus that China is recording in machinery and electronics products. Now, again, like the most obvious example of that is the auto industry, where China, over the course of the last 2 years, has gone from nowhere to being one of the world's biggest auto exporters. Now, in fact, as much as electric vehicles are a big part of that, the big driver, in fact, has been traditional vehicles coming out of China, right? Like it's not really electric. Vehicles are part of the process, but the big driver of that increase in auto exports has been coming from combustion engine cars rather than electric vehicles. Now, nonetheless, what's also happened is an increase in lots of other types of machinery and electronic products that China makes. And this can be seen if you do these different, because there's all of these different ways that trade statistics are published. You can look at them by 2-digit, 4-digit, 6-digit. Like the higher number of digits, the more detailed you are looking in terms of the products that China exports. Now, whichever way you look at it, and I've looked at this in quite a lot of detail, all of the things say the same story. The reason that China's trade surplus is rising is because of exports of manufactured goods. And within that, China is making a lot more progress in machinery, in electronics products, in these sort of capital goods sectors of the economy. Now, maybe that's not a big surprise to you. Like, there's obviously China's been very focused on this stuff, right? Like, in terms of China's policy, like you'd have heard of Made in 2025, of industrial policy in China. Like, China obviously wants to increase its self-sufficiency in some of these technologies precisely because it doesn't want to be reliant on the US. So industrial policy is playing a part in this. The other thing that's playing a part in particularly the increase in the trade surplus is that China's own economic cycle has been very weak. So another thing that pretty much everybody knows about China today is that the property market and property market activity has collapsed over the course of the last 5 years or so. Obviously, that means that the economy is growing less strongly than it was, and it means that domestic demand is also weaker than it was. So there are, like from both the export side, but also from the import side, there are reasons to think that the trade surplus would be rising. However, there are a couple of other things that really stand out about China here. So one is, if you think about the export structure and this move up the value-added chain, right, one thing to be remembering is this shouldn't be unexpected. That there are some particular reasons in China why it's happening, and again, industrial policy being one of those key things. But if you go back and look at the experience of Japan, Korea, or Taiwan, and these are, like, China is going to be different in terms of the way it develops in some respects. But the thing that stands out about these other economies in East Asia is that they were all exporting economies, and they're some of the few economies in the world that have made the transition from being poor economies to being rich economies over the course of the last generation or so. So they are relevant to thinking about China today. And if you think about these economies, they all made this transition, that over the course of time, they moved away from making low-value manufactured goods to making capital-intensive goods. That's what's happening in China today. Therefore, that shouldn't be a surprise. So the fact that China is making EVs and exporting more machinery and taking market share away from Korea, Japan, and Germany, that's not a particular surprise. It's important for those economies, and it's important development for the world economy as a whole. But it's not something that we should be thinking is particularly unique to China, right? This is sort of more part of the development process. What stands out beyond that, though, are two things. First, in these other economies, as they made this transition away from low-end goods towards higher-end goods, their overall global market share started to come down. So this is in a way a trade-off, right? They moved into making more higher value-added goods, which is good for economic development and so on. But the trade-off of that was they lost labor-intensive products. And labor-intensive products tend to move to other economies, and therefore their global market share in terms of exports fell. And that was particularly obvious in Taiwan and Japan after 1990, 1989 or thereabouts. So there was a clear trend, there was a cost to the export transition that occurred. Now, if you look at China today, that just isn't happening. So the export transition is very common with other economies. But if you look at China's market share, it's increasing more quickly today than any time since China entered the WTO back in 2003. Now, back in 2003, China's global market share was very small. So increasing it wasn't a particularly big challenge. Today, China is already the biggest exporter in the world, and yet its market share, particularly in volume terms, is increasing just as quickly as it was 20 or 30 years ago. That did not happen in Japan or Taiwan and Korea. That is one of the things that's very unusual about China today, and is obviously important when the rest of the world is thinking about protectionism and so on. The second thing that stands out about China is that as that process played out in the other economies, import demand tended to hold up as well. So just as they were losing market share externally, they're also steadily increasing the proportion of imports coming into their domestic economies. Like, there were different reasons for this, right? One in Japan in the 1990s was because Japan was a very protected economy. And so there was a lot of room for liberalization, which allowed cheaper imports to come in. But the point is that this was an offset, right? So on the one hand, they could be exporting capital goods to the rest of the world. On the other hand, they were importing more domestically. Now, that hasn't happened in China. So again, if you look at these two things, both in terms of the export side, like this big increase in export market share that's happened over the course of the last 2 years or so, that's exceptional. But just as exceptional is how quickly China's import market share has fallen. Like, it's really, so before 2020, the model for China was export steadily rose and import steadily rose as well. Maybe not at quite the same rate, but nonetheless, China was steadily becoming a bigger import market for the rest of the world. Since 2020, that is just not happening anymore. China's import market is not growing. It's becoming a smaller market for other countries to export into. And again, that wasn't what happened in the rest of East Asia, at least not until Japan's economy really started to get into difficulties. So there's two things here that really stand out. So how to explain that? And what's the significance of it? Now, again, there are various things we can point to, right? So there's the collapse in the property market, the problems with domestic demand that China has very clearly had, and there's also the industrial policies that China has pursued. And one of the aspects of industrial policy, which is important, is if you are becoming better at making technology and different products, there's a very clear process of import substitution that happens as well. So like the success in exports feeds into reduced need for imports. So there are reasons you can explain some of these things. We're talking about this weakness of import demand in China. And again, like, some of the reasons is because of industrial policy and some of it is the import substitution. Now, there is a complication in China in trying to get a sense of what true import demand should look like. And the reason for that is because historically, China was unusual in the sense of having this massive outsourcing from the rest of the world into China. An outsourcing that was primarily done by foreign companies. And so when you look at that in terms of the statistics, well, it shows up in a couple of ways. One is there are data in China for the percentage of exports that are made by different types of company. And so you go back and look before the financial crisis, the majority of exports in China were indeed being made by foreign companies. The second thing is that fitted in with a big increase in FDI. So if you look at historically across East Asian economies and their development, foreign direct investment from the rest of the world has never been very important. It's already been very low. Now, arguably, that's a negative thing for these economies, particularly these days, because foreign direct investment does bring technology and different management takes and so on. But nonetheless, the fact is that FDI, particularly during development, was very low. In China, that wasn't true. FDI from the 1990s through to about 2010 was very large, and a lot of that FDI was associated with this outsourcing trend. So why is that important? Because that FDI also meant that China's foreign company factories working and operating in China had very close relationships with mother companies back in Taiwan, Japan, and Hong Kong in particular. And so there was a natural import demand as these companies overseas shipped processing exports into the factories in China, which they were exported overseas. So why is that important for what we're thinking about today? Because that meant that imports as a percentage of GDP were very large historically. As FDI has fallen, And as there's been a shift away from foreign companies towards domestic companies producing, import demand would sort of naturally fall without having anything to do with what's happening domestic demand in China. Now, there's two other things to say about that. One is that it's important to realize that this increase in exports that China has had over the course of the last few years, it is very much driven by domestic firms, and particularly by domestic private firms. It's not state companies doing the exporting from China. It's very much private companies doing the exporting, or at least non-state companies doing the exporting, which is probably the right way to put it in China. That in itself is important because, again, people who follow China for a long time will know that particularly around sort of after the financial crisis in 2008, there was a lot of concern with this concept of the state entering and the private sector receding. The state sector was growing in the economy. I think there's reason to think that that's changed in recent years because of how successful the export sector has been, and because of the underpinnings of that private sector the underpinnings of that export sector is indeed the private sector. But the second reason we're talking about this today, again, is to get a sense of how weak is import demand in China. I think even allowing for that, and the fact that there has been this big structural change in the way that Chinese exports are produced, even allowing for that, it looks like import demand has been weak. And one of the ways of showing that is these charts, which look at the percentage of imports in China that are consumer goods. And if you go back relative to other economies in the region, that has also both fallen and also looks like it's very low. And so I think it's not just the weakness of imports in recent years. It doesn't just reflect a sort of high base that import demand was abnormally high in previous years. It's also because China isn't importing as much as it probably should be, and that's reflected in what's happening with the consumer side. So in any case, those are kind of some of the things that are playing out. But the other big reason here, and I think the other thing that it kind of suggests is going on, is related to what's happening with the currency. But I think one of the things that's going on is the fact that the currency in China still remains very weak. So if you go back, and again, I've talked about this in other videos, and this is kind of one of the features, particularly of Japan's economic story over the course of the last 30 years, but to some extent Taiwan, that the big thing in the 1980s, when these economies made this transition away from lower-end goods towards higher-end goods, one of the things that contributed to that and contributed to import demands holding up was the fact that currencies appreciated. Why is currency appreciation important? Obviously, because it means that it's labor-intensive stuff becomes less productive and therefore becomes less competitive as the exchange rate moves. But also, exchange rate appreciation gives the household sector more purchasing power. And so, if you think about particularly Japan in the first half of the 1990s, the currency went through the roof. So as a result, Japanese households' relative global purchasing power also went through the roof. And that's one of the reasons why import demand in Japan held up even as the economy was weakening. Now, if you look at the exchange rate in China today, that just isn't happening. Now, you can look at the exchange rate in different ways. So there's a bilateral exchange rate between the CNY and the US dollar, which is the most commonly internationally followed one. Essentially, that isn't really changing, right? It moves a little bit, but it moves nowhere near as much as currencies in the rest of the world. And it's sort of remaining around kind of the levels it's been of recent years. Where the change is more evident is if we look at the exchange rate deflated by the cost of production or the consumer price inflation in different economies. So the idea of doing this is you don't just look at the bilateral exchange rate, you try to look at the exchange rate relative to all of China's trading partners, and then you also look at the price levels in those different economies. And if you do that, you're adjusting for the cost of production, essentially, that these other economies have. And so the real effective exchange rate is probably the best way of thinking about the price competitiveness of an economy today. So if you look at this chart, it shows it very clearly. What's happened over the course of the last few years is a very steep depreciation of the CNY on a real effective exchange rate basis. So even before this year, China was as competitive on a price basis as it had been since 2014. So this is not the experience of Japan. This is not an economy that's becoming less productive over time. From a price perspective, China is becoming more productive over time because the really effective exchange rate is falling. Now, if you look at that chart again, the other thing you'll notice is over the course of the last couple of months, that fall in the exchange rate has actually accelerated. Why has that happened? Well, because the US dollar has depreciated against just about everything, and obviously particularly against the euro and particularly against some currencies in Asia like the Taiwan dollar. Now, because that process is playing out while the CNY US dollar exchange rate doesn't change, that means that China gains the competitiveness that the US dollar is gaining as well. And so again, you've seen this further fall in China's exchange rate, and therefore a further gain in competitiveness. So if you go back and think about this picture, China's export sector has been on fire. Like, it's hugely gaining massive amounts of market share, leading into a much bigger trade surplus that China has. Import demand, conversely, is very weak. As that process is playing out, the trade surplus is getting even bigger. The currency doesn't appreciate. In fact, it depreciates, and China is becoming even more competitive than it was 5 years or so ago. So you'll see, I think, that this is something of a contrast and something that seems quite important. So what would you think in another economy if this was going on? That you had like this super effective, like super competitive export sector, like taking market share from everybody, trade surplus is rising. Usually you would expect that that starts to lead to currency appreciation. And instead what we're seeing in China is currency, at least in real effective terms, as currency depreciation. So what you can say is like one of the sort of conclusions or one of the implications, I think, would be that, you start to say, well, actually, the CNY should be appreciating against the dollar, that there should be a more expensive exchange rate on a bilateral basis, which over the course of time, if the currency appreciates against the US dollar, that means that as much as prices domestically are falling, that eventually China starts to lose competitiveness. And because the exchange rate is appreciating, domestic consumers in China, they become richer in terms of the amount of stuff they can buy from overseas. And that's one of the reasons why import demand can start to rise. And it's also one of the reasons why the economy can start to kind of rebalance towards consumption. A third thing I think is important in thinking about why exchange rate appreciation might be helpful for China is because the Chinese Communist Party has an official aim that by 2035, China will have an income per capita, in US dollar terms, importantly, an income per capita which is on a moderately rich country basis. Now, that's never going to happen if the exchange rate doesn't appreciate, or at least it means that growth is going to be able to, growth in CNY terms is going to have to be a lot faster for China to be able to meet that aim. So there's various reasons why you would think that currency appreciation is not just natural because of the trade competitiveness that China is gaining, but it also something that which should be helpful for China's economy and as a way of sort of taking that exchange rate or that export competitiveness that China has and using it to generate more domestic incomes and a better standard of living domestically. Why isn't that happening? That leads to the big contradiction in China's economy. Because if you look at the domestic cycle, and I've talked about reasons why it's so weak, the property market is a mess in particular, but there's other reasons why the domestic economy isn't very strong. And again, partly because there does seem to be some overcapacity in particular industries. But the domestic situation that China faces, the key domestic issue is that China has deflation, like prices are falling. And in fact, we just saw that today. Like China released both CPI and PPI data for June, and those data show that inflation continues to fall. And in fact, people look at the GDP deflator, and the GDP deflator in China has been negative for the course of the last few quarters. But inflation data through June suggests that the GDP deflator is deepening further. The deflation in China's economy is getting worse. It's not getting better. Why is that relevant to the exchange rate? Why is that important? Because if you have deflation, most economists would say that the currency should be weakening. The currency shouldn't be strengthening. Now, why is the reason for that? One is because exchange rate depreciation is a way of loosening monetary policy. It's a way of loosening monetary conditions, and therefore it's something which should, hopefully would drive up inflation over the course of time. So if inflation is too low, interest rates should come down. If interest rates come down, you would think that would be something that would lead to a weakening of the currency. But the other reason why it's important directly is obviously because if the currency weakens, it means that import price inflation is going to go up. And import price inflation going up is another thing that can help to drive inflation and offset the deflation that China has. And this is an important issue for the economy. So in the sense, economists kind of theoretically would try to say that, if you have if prices are falling, that tends to be something which means that consumers tend to push off purchases into the future, right? If you're a consumer, you don't want to buy now because you see the prices are going to be cheaper in a year's time. Now, there's some debate about whether those things are relevant in China, but one thing we can say with quite a lot of certainty in China is that deflation does tend to be very negative for corporate profitability. So as this chart shows, there's a very strong relationship between what happens with PPI and what happens with corporate profitability. And so if we look at where we are with, equity markets in China today, and there was some recovery in September, October last year, but, the equity market clearly is not on fire. Well, the reasons for that is because corporate profitability is so weak, and that's very much related to how weak prices are. So I think this is kind of, for me, at least in my mind, like this is the critical sort of contradiction, the critical issue that China really faces. On the one hand, you have this fantastically competitive export sector, which strongly argues for the exchange rate being far too weak and the currency should be appreciating to allow the domestic economy to gain some of the benefits from the export competitiveness. On the other hand, you have this domestic economy, which is already extremely weak, is suffering from deflation, which argues the currency should be weaker. It shouldn't be stronger. So how to get over these two things, right? So one thing I think this means is if you look at markets in China and look at the CNY, like it's not really going anywhere. And there was, I was certainly in this camp that, it looked like the path of least resistance for the CNY as Trump imposed tariffs was for the currency to weaken even further. And now that hasn't happened. And I think maybe one of the reasons that hasn't happened is because you do have these two things trading off. That on the one hand, the export sector is strong. On the other hand, the domestic economy is weak. But I think this is the critical issue that China faces. Now, how can we square that circle? Like, how can we make sense of that contradiction? Is there a way out? And I think for my mind, if there is a way out of this, it's that's going to provide direction both for China's cycle and therefore for Chinese financial markets over the course of the next 6 months. So if we look at where we are, not just with the equity market, but with the CNY and with interest rates in China, basically very little has happened over the course of the last 6 months. I think for that to change, it really is dependent on this contradiction between the CNY and deflation, that contradiction being resolved. How could it be resolved? The obvious thing is some fiscal policy. And I think fiscal policy, like a lot of people would favor fiscal policy being focused on the household sector and the consumer sector in China. I would sit in that camp. I think that's something there's a lot of room for China to be using fiscal policy much more effectively in terms of boosting consumption. You might want to argue that you don't need to do that. The essential point is all you need to do is mobilize consumer savings. And so if you look at this chart, this shows what's happened, the big change in China's economy from a domestic perspective over the course of the last 5 years or so. It's not that consumers are saving. It's not that consumers are consuming less. It's not that they're saving more. What's happened in China's economy is that consumers have stopped buying property. That's been the big change in the economy, that they're not using their savings to purchase property. So if you think about that differently, what's needed is the government needs to find some way to mobilize the consumer savings that were previously going into property. That might be by mobilizing those savings to go and consume more goods. It might be because the government comes up with some big infrastructure project or something which effectively mobilizes money to move back into the economy. If that happens and inflation starts to pick up in China, that, to my mind, provides the foundations for the CNY beginning to strengthen. And with the trade surplus still so high, there's good reasons why the economy should be able to withstand that strengthening of the currency. And if that happens, that's something that's positive for household incomes that could feed into more consumer goods being imported. And therefore, that becomes more of a reinforcing cycle for the future, which allows China's cycle, which has been moribund for the course of the last 3 years or so, that cycle's starting to rebound, and therefore Chinese financial markets starting to get some direction. So again, I think what I've talked about today is sort of like three main issues, I think. So the first is what's happening with the export sector and try to demonstrate like just how kind of structural that this rise in the export sector and China's market share globally has been. The second thing is to contrast that with what's happening domestically, where prices are still very weak, the economy is still very slow, and the big issue that the economy faces is deflation. The third thing then is the contradiction of those two different pictures and the implications for the CNY. So when I look at China's economy, so far in the last few months, it's just been very difficult to get excited about from a financial market perspective, that there isn't any change in direction. And I think I can see that there is room for direction to change, but to my mind, that change happens because there is a fiscal policy that's big enough to drive up domestic inflation, which then allows the currency to start to move. So if that starts to happen, I think financial markets and the cycle in China becomes something that's much more exciting to watch and much more relevant for investors. Until that happens, I suspect we're still caught in this situation where the CNY really can't go anywhere because of this contradiction between exports on the one hand and domestic side on the other. If the currency isn't going anywhere, then it doesn't feel like other markets are going to move very much at all. Now, as I said, I run East Asia Econ. We're a small firm looking at the economies of China, Japan, Korea, and Taiwan. We have a huge amount of analysis and charts on the website. So if you're interested in finding out more about these issues, then please do check out that website. And if you're interested in subscribing to our service, then please get in touch with me. Thank you very much for watching.